When the first rates after a one-day break, indeed it's a good start for a new year. And the first rates are 171 points up for the Nifty. Breadth is touch wood. Absolutely amazing. 1:15 advance to decline ratio. It's like a rara move in the market in terms of the market breadth and in terms of the risk reward ratio. I mean, everybody talked about, okay, bubble in the small cap stocks, but that's where all the action is. We can endlessly get into small cap bubble, but you should also respect the market action, which is that markets can remain extended for an extended period of time, which is what it is now. You've got some newsmakers now. Let's address some newsmakers now. And right on the top of the heap really is going to be IndusInd Bank. Then you've got Manappuram. Then you look at Jubilant. Manappuram Finance has a hit out of the park, both in terms of the numbers and where the market opinion now is. I will not be surprised. That's IndusInd Bank for you. Let's look at Manappuram Finance. Circuit up, I think. It's an FN. No, it's not circuit up. 152, 11 rupees higher now. Now, we forgot to speak about it, but what has happened to Diwali sales? The real impact of that on jewelry stocks, retailers, autos, consumer durable, consumer discretionary. That theme I think is very, very evident in terms of where the things are. So jewelry stocks, retail stocks, car stocks, urban FMCG, that entire space now today could be the real, trade of the day or real, the market focus of the day at least.
The day also seems to be in IT. That global rally that we had seen is having an impact back home as well. So you have the IT stocks which are actually opening up well. Case in point in Infosys, LTI Mindtree as well. Real estate stocks continue to power ahead. So Phoenix Limited, Brigade, as well as Oberoi Realty, these are some of the stocks that deserve mention. Talking about individual names now, result reaction on a Trident, which is higher by 7%. The profitability had become 2.5x, I believe, and that's the reason that stock is up by 7%. Narayana Healthcare is the other one. You also have Natco Pharma reacting positively to its earnings. And you can also look at a few other buzzes as well, the likes of Suzlon, Hindalco, RVNL as the top gainers. On the losing side, however, NMDC disappointed a bit with its earnings, and Dabur too is seeing a bit of a sentiment downtick on account of that entire cloud which is there on the entire Bourbon family for now. So that stock is down about 1.4%. But if you look at the broader markets, it's the small cap stocks which are actually buzzing. So Reliance Power is actually up. JP Associates is reacting to that deal that it has with ICICI Bank as well. So small cap names are also having a good day. But overall, a very strong start to the trading session, 19,600 Avan.
Absolutely. And like you said, it's those small cap names. By the way, 19,600 is the print that we're on the Nifty. So Manappuram, Suzlon, JB Chemicals, IRB Infra, Sobha, Birla Soft. You're seeing a lot of traction and action really within the broader universe. A lot of those banking names as well are holding out quite well. So Kunal, let's get in your take. What's the first trade? How are you looking at the print of 19,600?
I think excellent start for the index, back again above 19,600 mark, and the bank Nifty is above that 44,000 mark. I think that's the more important next to watch out for in terms of a breakout. Now the stock which I would look to trade in the open would be on DLF. Real estate stocks have been doing exceptionally well, and DLF is heading towards a breakout about that 600 mark. So would be keen to buying the stock.
Okay, Naresh, let's find out what your outlook is on the Nifty Bank Index. You were saying that it's a hold recommendation.
So continue to be a hold on the bank Nifty, but stock specific on the bank side looks very interesting. So City Union Bank has breakout, and now Federal Bank is also. So Federal Bank looks interesting at 153, 154 levels for a further move towards 165, 170.
Anand Shah joins us now. Let's connect with him. Let's talk markets and what he makes of the current market setup. Anand, good morning. Thank you for joining us. Anand, the strength in the market is mesmerizing. I mean, there's a long list where market should go down, and hardly few pointers left where market should go up. But markets are focusing on those few pointers, not the long list where it should come down.
Hi, very good morning. Great to be here. So this has been the story for practically last 3 years. We have been living in a very tough macro environment, be it COVID wave 1, COVID wave 2, and more recently Russia-Ukraine-led inflationary environment where the energy price and everything went up. So macros have not been easier for last 3 years, but when you see bottom up and when you see earnings trajectory generally for the index, but also broader market, that's been very, very strong. Small caps and mid caps have been outperforming. And within that, The earnings growth is also very much stronger than what we are seeing in large caps. Also, that's also reflecting more of a micro and a domestic story, whereas the macro remains tough. So to that extent, market's been not actually very euphoric. It's just chasing earnings. It's just chasing the reality that the corporates India, and especially within that, the segment which has been doing very badly for a decade, which is manufacturing and manufacturing related businesses, the B2B businesses have been doing very strongly.
So where are you investing in this market? I mean, where are you picking your spots?
So again, banking, while it's been very soft, large cap banking, we have been seeing a lot of FI selling within that segment. So despite of fundamentals remaining strong, earnings also coming off fairly strong, the stocks have been subdued. To that extent, the valuations have become very attractive. So banking remains the top pick among the many sectors, but outside that, there are many segments within metals in manufacturing, auto ancillaries in manufacturing, industrial cap goods, which are on the manufacturing alike. These are the areas where we've been sort of positive. Outside that, there are many bottom-up ideas in sectors which have been stressed for a while, telecom being one, airlines being another, hotels. This is again the sector which almost for a decade and a half didn't make reasonable money. And to that extent, the supply is limited, both in airline, in telecom. Obviously, I don't see new players entering in that area, nor in hotels much supply is coming through. So it's a decent environment to be in that segment.
Anand, hi, this is Anisha also joining in the conversation. I was just looking at your contra strategy in the PMS, and your weights for financial services is 33%, manufacturing is 32%, manufacturing allied is 21%. None of these really seem like a contra strategy to me right now, because all of these names are something which people are quite bullish about on a consensus basis. I would believe IT or even other names might be a bit of a contra strategy, but what how do you define financial services and manufacturing as a contra theme then?
Indeed, I mean, this is a stocks we picked up in our portfolios 3 years back, and definitely they were not in flavor at that point of time. But even when I look at today, and when I look at the risk reward in these select stocks that we've been owning in this, they still remain fairly attractive. I think the way we define contra is the stocks where actually the implied growth is much lower than what we believe would be the growth in times to come. And in that context, the select stocks that we own today still remains fairly favorable from a risk reward perspective. I spoke about banking a while back, that the earnings trajectory remains strong. Balance sheets have been very strong. Asset side performance has been fairly resilient. And despite of that, the stocks have been sort of subdued.
Okay, fair enough. That's the view coming in on that contra strategy. What about the outlook on the power space, energy space, etc.? How have you looked at the kind of announcements that we've seen on this front, steps taken by the government, how the stocks as well have fared?
Indeed, I think if for any country to do well, energy is of paramount importance, as Indian economy remains strong, and that reflects in the power demand growth. Again, as I spoke about hotel, airlines, I think this is another sector where I would want to believe there has been underinvestment for a while. We were at one point of time adding thermal capacity very strongly, and then we at some point of time reached the power surplus stage. And since then, there has been not many new, especially the coal-based power plants coming through. So we are reaching a point where we are now in a little bit of a deficit, and this deficit will only widen if the economy continues to do strong. So I think this is one sector, again, which comes within the manufacturing allied businesses. The utilities, we have been fairly positive on this sector, and even the allied sectors like cap goods, which provide new power plant capacities, both in thermal as well as in renewables, they also remain attractive for us.
Okay. My point is that why banks are not doing well, and while we may talk about it as contra or maybe FI is selling. The bottom line here is that everybody likes bank. I'm yet to find a bear on HDFC Bank. I'm yet to find a strategy report which says, bank should be underweight. So isn't this a consensus view where markets are already pricing in 2-3 years ahead?
Indeed, Nikunj, that's the beauty of the markets. If it's anything is a consensus, it's a lot of things is priced in. Here, I think the other thing that is happening is if you go back into the history and if you see the ownership pattern of foreign institutional investors, there is a significant ownership in financial stocks and IT stocks. And one consistent trade that you're seeing for last at least 2 to 3 years have been that with the rising interest rates in US, there has been a consistent net FI sales happening, bearing few months here and there. And at the other end, you have a consistent domestic buying through SIPs and lump sum inflows that the mutual fund and the insurance are getting. So this is one consistent trade. Now there, if you see, the ownership patterns play a role where the selling largely is happening in large cap banks, large cap IT companies. And when you're seeing the domestic buying, it's happening in banks and IT companies, but it's happening much in the broader market. Even the research depth that exists in the domestic institutions is much deeper. So we actually can go down and see where is the value in mid caps and small caps. So I think this is one technical reason why I would want to believe the banks are sort of, they've been doing well, but they've been relative underperformer vis-a-vis the mid and small caps.
Airlines, telecom, hotels. Now, these are typical high capex businesses, right? I mean, it's like saying that 2 years they do well, 3 years they do badly. Is there really merit in owning them now because A, run-up has been strong and B, soon they will come to the market, whether debt or equity or both, they will have to need capital to grow?
Here's an excellent question. I think this is, it's been last capex cycle we have seen, and the last time when this many capex intensive businesses did well was way back in 2007 or 2008. And since then, it's been a tough time for them. I think there is a merit. The country would need both the asset-light businesses as well as asset-heavy businesses. The question being, would the high capex industries make return on capital invested, or the ROC and the ROEs, which are better than the cost of capital? That was not the case for last 10 to 12 years. We had GFC-led slowdown, and subsequently China continued to export deflation to the world. So we didn't have pricing power in many of these manufactured goods. And to that extent, the return on capital employed was very little. On top of it, they had done greenfield capex. There were some delays there that led to high debt on the balance sheet. So both was not working in your favor. The stocks did very bad. I think the last 3 years have been testament that these businesses have now generating good cash flows. They've improved. I don't think they are at anywhere near the peak return on equity, but they have improved their return on equity. Most importantly, the capital allocation. Every company that we meet is extremely conscious of when we would do capex and how much capex, whether we'll do only brownfield. So they're thinking a lot more today about return on equity and capital allocation. And that's, again, is a very positive news. If you see, we've been talking about India needs capex, India needs new capacities, but it's not coming through. The businesses are fairly cautious about putting up new capex, and that's a good news for the shareholders in general.
Anand, on the overall liquidity situation, how are you looking at the fact that the FIIs may be on the fence or have taken a back seat, and it seems to be the domestic flows which are keeping the markets afloat? Is that a trend that's here to stay?
I think domestic investors are not going away anywhere. I think SIP has been an extremely good vehicle for retail investors. The volatility in market, which generally shakes the confidence of retail investors, SIP is exactly the right medicine for that. I think to that extent, that inflow remains strong. I think a lot will depend on where is the US inflation number and what is happening on the Fed side, whether we have seen the peak of interest rates, or we are going to see much higher interest rates, or at least the higher interest rates for longer from here. That would decide what's happening on the FI flows. I think the impact of higher interest rates also is reflecting, if you see in the markets, in terms of how selectively value-oriented stocks, the stocks which have more cash flows today, are relatively doing better than the growth-oriented or the tech-oriented businesses where the cash flows are a few years later. I think that's also one reflection how the value trade is doing better than the growth trade in the markets.
On that note, we let you go. Appreciate you making time and speaking with ET now. But quickly taking a look at which are the top buzzers right now. So Manappuram, of course, was one stock that had opened with a gain of 8 to 9%. Phoenix Mills is actually inched higher. It's gaining almost 9%. And then you have some of the cement names, a Star Cement, which is higher by 6%. Hindalco is actually doing quite well. Trident is also result reaction, and ditto can be said for Narayana Healthcare as well. On the losing side, NMDC and Aster DM, these are a couple of stocks that are coming up on my radar as well. But one such result reaction is also Finolex Industries. Let's welcome on board Ajit Venkatraman, the MD at Finolex Industries, to talk to us about their earnings as well. Ajit, hi, good to have you on the show. I was just going through your numbers, and whether I look at the revenue profile or the EBITDA, it's a bit of a slip on a year-on-year basis. Despite this performance, you expect a pickup in the second half, and hence you're maintaining your 15% volume guidance for the year?
Correct, but let me just point out that on a year-on-year basis, although the overall revenue has been down, the pipes and fittings business has grown, and the EBITDA margins have seen a dramatic turnaround from almost 143 crores loss last Q2 FY23 to 103 crores of profits in FY24, and therefore mainly the volume drop has come especially due to the resin business being down significantly, almost 38% year on year, mainly due to some supply related issues. But going forward, yes, the business is picking up, and with the stability in PVC prices, we expect a 15% growth.
The volatility in the number, is this all function of commodity prices, or this is something else in the industry which is happening?
See, typically, yes, the Q2 is always on the lower side, and it's the weakest quarter for us historically. This is mainly due to the rainy season, and that is playing out this year as well. Other than that, I don't think, and PVC prices being stable, we did see some amount of volatility from the second and third week of September, leading up to almost half of October, but that has stabilized, and stability in PVC prices brings stability in the business itself.
Talking about is a year-on-year comparison, right? Which is that the same Q2 must be at play last time also. Last time volatility in raw material price was much higher than what it is right now. So a point here is that why is that on a last year-on-year comparison volumes have plunged?
So let me also bring up what happened last year. There was a significant drop. We were left holding a lot of high value inventory. I think that was an industry phenomenon because the price did drop, and therefore we had to take some inventory losses. But this year, right from say November last week of November in 2023 till now, the prices have been fairly stable compared to the previous 2 or 3 years. So that is one of the reasons contributing to the loss which you saw last year. That results in volatility. It is mainly driven by PVC prices.
When you say that you're confident of a 15% growth, is this based on rural demand? Is this based on normalization?
It is both the sectors which we participate in, the agri segment and the construction segment. Both are showing fairly robust growth. In the agri segment, we did see a little bit of drop in volumes, especially because of the volatility which we saw in the last part of Q2. But that has stabilized, and the last few weeks we have seen significant pickup in demand in agri. Construction segment has been showing robust growth, which is between 15 and 20%, and we expect that it will continue. So that is the basis on which we are saying that we are likely to see a 10 to 15% growth.
Outlook on the agri and the non-agri segment, because Q2 is a seasonally weak quarter for the agri segment. So what's the outlook?
So still, for the year, we expect anywhere between 8 and 10% is what we are expecting. Last year, we did see a significant spurt in Q3, resulting in the highest quarter Q3 ever for us. But that was largely due to the pent-up demand from the previous years when the PVC prices were really high and the farmers had stopped buying or delaying, postponing their decision to buy pipes, which picked up really well last Q3. This year, we don't expect it to be that high, but we still are seeing a fairly robust demand.
Your margins as well have been a little bit volatile. So, what is the kind of level that you believe looks sustainable when it comes to your overall margin profile?
Given the product mix we have at this point of time, we expect anywhere between 10 and 12 rupees per kg.
Have you on board. Thanks so much for joining in. That's the outlook on the management from the management of Finolex Industries, talking about some little bit of volatility in the PVC prices, but now they've stabilized and robust growth seen in the agri and construction segment. Quick break right here on the show. Don't go anywhere. When we return, we'll be talking to Akash Agarwal. He's the whole-time director at V2 Retail about the consumer demand this festive season.
Well, Akash Agarwal, whole-time director with V2 Retail, joins us now. How this Diwali essentially has been for the retailers. Now, the data which we've got, which is that, there were long queues, there were endless queues outside jewelry stores. We've been told that small towns, the retail engine which had slowed down this Diwali seems to be making a comeback. Now, whether it is a consumer durable or a mobile manufacturer or a jewelry retailer or a fashion retailer, the trends for this Diwali, according to estimates, have been very strong. So, has the tide turned? And are things looking up for the entire semi-urban market? Let's pose that question to Akash Agarwal, whole-time director at V2 Retail. Akash, good morning. Thank you for joining us. What's been the update for this Diwali season? I mean, the estimates what we are getting, all crazy numbers which are flying around. Is there an element of truth in that?
Hi, good morning. Yes, we have seen a very good uptake in the footfalls during the Durga Puja as well as the Diwali season. And in fact, we recorded our highest ever monthly sale in the month of October. And we've been seeing a steady double-digit same-store sales growth over the last 7 months. And we've seen it continue to Diwali. And we're expecting a good winter season as well because of an early onset of winter. So all in all, we have a very positive outlook on this quarter as well as going forward.
Relative sense, like what did well, what exceeded your expectations, what has been the industry trend per se, because the category which you represent, which is value retail, that in a sense is been a category which has been under intense pressure.
So I would say that we had implemented 8 to 10 new things and we focused a lot on product. So our offering is much better than what we had last year in terms of pricing and in terms of assortment. So we saw footfalls increase by more than 30% over the last 2 months, and we're seeing the same trend in the current month as well during Diwali. So it has been a good problem to have for us because the sales have exceeded our initial planning, and we're trying to fulfill the stock as to the best we can.
What about the outlook on the tier 2 and 3 markets? How has that been performing? Is there some sort of a clear divide in terms of where the demand is really coming from, rural versus urban?
So most of our stores are present in tier 2 towns, and we have seen this growth across regions, whether it's the Northeast, whether it's UP, Bihar, West Bengal, and Jharkhand. So we haven't seen any particular region do much better than the other. So it has been an overall rise in footfalls and rise in consumer spending. So it has been really good Diwali and Durga Puja for us.
In terms of, let's say, which category has done well for you and for industry, we're just trying to understand the pulse here. That the numbers which we have are itna ton sona bika, itne kapde bike, itne jute bike. How much of that is reality?
So we deal mainly in apparel. So 92% of our business is apparel. And we do all the categories from women's, men's, and kids. So I think our women's category outdid the men's and kids category, but I would say all three categories saw a big jump, and overall family spending has increased. So I cannot say that particularly one category did much better than the other. So it has been an overall growth across categories and across regions.
Say that that's been exception for you this year, or that's been the industry-wide phenomenon?
I think we are doing better growth numbers than our competitors. And I think this year we will close our highest ever turnover in the history of the company. So we are looking to close this year at around 1100 crores. And I think our growth numbers are really good, and we aim to achieve similar numbers going forward.
Up in terms of the outlook in terms of which sectors are likely to perform and do well down the line?
So I think because of rising middle class income and people's aspirations also increasing, so I think we are in the best space you can be in, because it's a ballooning middle class, and we target the income group between household income between 10,000 rupees till 60,000 rupees. So I think we have seen a very good demand in that particular value segment, and we continue to focus in that segment, and that is why we are also planning to open around 15 more new stores by the end of this financial year. So the expansion will also continue, and we're getting a good same-store sales growth. So going forward, like I said, the outlook is very good.
Talk about 15 more stores by the end of this year. What about next year, and which are the geographies that you're opening up these stores in? Is there a geography that you're targeting right now?
So we are trying to focus on the geographies that we are already strong and present in, because that really helps us with having an established brand name. So we have very, very well established in Bihar, in UP, in Jharkhand, in Odisha. So these are the regions that we're focusing in. And talking about the number of stores that we want to open in the next financial year, I think we will open around 20 to 25 stores.
Gosh, on that note, we let you go. Appreciate you making time and speaking with us. So that's the takeaway. Diwali has been quite robust when it comes to the retail sales in the hinterland of India. So good growth, 30% increase in the footfalls as well. But what about the markets as a whole? The big question that everybody was asking was, are the mid-cap valuations frothy? And one should prefer large caps over mid-caps over the next coming year? This is the question that we posed to a whole host of our market experts as well. Listen in to their verdict.
Right now the prices are slightly elevated, as are our emotions, but it's also justified. So if things do work out in the coming election and no accident happens in the world geopolitically, I think it's a decade of very, very strong growth ahead for us. The over-exuberance I find is really in the small cap SME exchange. There's something crazy going on there, and I think it's some accident waiting to happen. The small caps have gone up, but it's not large enough to damage sentiment for the whole market. Because normally you used to see some very, very large player or very large company blowing up. And that leverage leading to trouble. You don't really see signs of that.
Across small and mid caps, I don't see any value. And I mean, if you look at 100 companies, maybe 2 or 5 will appear to be reasonably valued. I would say 90-95 of them, even the good companies, are not offering value. So I think the long-term outcomes of investing in this space, I think, will be mediocre at best.
Markets are already going through that time correction in a broader market, not in the small and mid cap, but in the broader market. We spoke, Nifty has not given 5% return, and we are in the midst of a big bull market, right? So there will be a time correction. I don't expect that any 30, 40, 50% of correction, unless there is some black swan event, there is big political instability in 2024 election, or something globally really goes wrong, world war kind of thing, so that is impossible to predict.
Last 6 months, 1 year is mind-blowing. I mean, like index has done 8%, median is smaller than 20%. So that excitement brings all the crowd into following. In fact, after 20% return, you should run from there and go to the large cap. because large cap is going to do that next 20%. Now mid cap and small cap had their breathing up. Now they have to breathe down. Large cap had done their breathing down. They have to breathe up.
Clearly, the mid and small cap funds have done extraordinarily well in last 3 months, 6 months, 12 months, but that should not be extrapolated. Our mid and small cap funds may have delivered 25-30% over the last few months, but you cannot expect 25-30% every year. You have to look at the long-term track record. As of now, purely from a valuation perspectives, large caps clearly look better than the mid and small cap at the index level. But of course, as I mentioned earlier, the trick is in the stock picking.
Good to have you back with us. The momentum in the markets is intact. It's a 1% gain on the frontline index, and across the board, the Brits skewed in favor of the gaining side. Traction seen in the likes of ONGC, Hindalco, JSW Steel, TCS, as well as HDFC Life. But let's keep the spotlight then on corporates, and Home First has seen a 30% AUM growth in FY24. Have the margins for housing finance companies topped out? What's the outlook on asset quality? Manoj Viswanathan is the MD and CEO here to discuss that and lots more. Good to have you on board. Let's just start off with the numbers, because you're confident of a 30% AUM growth in FY24. But do you think that you can sustain on a higher base going forward?
We have looked at the outlook for the next 3 years, and we feel confident of maintaining this 30% AUM growth. This is based on ground level feedback in terms of the demand and overall development that is going on in various parts of the country, because affordable housing is a segment that is dependent on employment generation and incomes going up. So we are finding it, we are finding the feedback positive from across the country.
Just a question, in terms of these housing loans, we have been seeing that it's a luxury market which has been doing a lot better than the affordable housing. Is that a trend you are witnessing as well, or maybe some increase in your ticket sizes that you have seen when it comes to the housing segment?
Affordable housing segment has been, very stable segment all through. If you look at look at the last 10-year trends, whereas the premium housing goes through, ups and downs depending upon interest rates and various other macro events. So, because affordable housing is a segment that is dependent on customers who are actually end users who are looking to buy or build properties, for their own residential status. So. As such, the demand, generally we have seen the demand to be very stable across cycles.
Okay, fair enough. And a couple of factors, because there's been comparatively lower demand for affordable housing versus luxury, sequentially higher bank balance transfers. Keeping these factors in mind, do you think that there could be a little bit of challenge to your growth going down the line?
As I mentioned, we are feeling fairly confident about our growth targets. We have been talking about, 3 years ago when we listed the company, we were talking about a 30% growth year on year. We have maintained that. Even today, we have kind of done the, outlook planning for the next 3 years, and we feel confident about maintaining a 30% AUM growth.
Okay, I just wanted to understand the competitive intensity in the industry as well, because of course we have been seeing a lot of these players also come into the housing finance space, specifically the affordable housing. A lot of peers have also indicated that they will cut the home loan rates as well in terms of getting more market share. Is this a strategy you would employ as well, repricing loans at a lower rate perhaps?
Not really. Affordable housing is not, if you see the segment, it is not that elastic when you look at the interest rates. The segment operates at a slightly elevated interest rate level compared to premium housing. And, within that segment, it is the demand is not elastic. As in, if we reduce the rates marginally, it is not going to increase our business, multifold. So as such, we don't see rate war or a rate pricing war as being an important factor in the affordable housing segment.
what will be your NIMs in that case, your yields and spread going forward?
Spreads, we have always guided to a 5.25% or thereabouts, spread. And we have sustained slightly higher spreads in the preceding few quarters. That is because of, a sharp reduction in interest rates post-COVID. But we have always been guiding, over the last 2 years that the steady state spreads in this business are more like 5.25%. And we are confident of maintaining those kind of spreads. The NIMs are currently around 6%, and if the interest rates don't go up from here, then we are confident of maintaining those NIMs.
Okay, that's a view on NIMs and maintaining your spreads. You also have a strong capital adequacy ratio, around 45%. What is the headroom you have in terms of your ROE expansion, and how are you expecting this ratio to evolve?
Capital adequacy is, of course, very strong, and this is because we have raised multiple rounds of capital in the last 3-4 years to, protect against, various macro events that have taken place. As we keep building the AUM, this capital adequacy should we should be able to keep absorbing this capital. Of course, the regulatory threshold is only 15%, so we have a long way to go as far as the capital is concerned. As far as ROE is concerned, when we listed the company, we said we'll deliver 15% ROE in FY25. We have delivered that 1 year in advance. So if you see the last 2 quarters, we have delivered a 15+% ROE. And here on, we are confident of increasing that by about 75 basis points every year.
Sure. In terms of your asset quality as well, Manoj, a slight deterioration, if you will, as far as the asset quality is concerned, but still, when you compare it to your peers, it's still looking okay. Is there something that we need to get worried about in terms of the cyclicality of the business and the asset quality worsening?
Asset quality has been fairly stable. As you can see, there has been, a minor 10 basis points movement last quarter. First quarter of the year generally is, a little worse than the second quarter. So we are confident of improving that going forward.
All right, fair enough. And going down the line as well, you have several notable PEs investors. What are the kind of conversations that you're having with them? Have there perhaps been any internal targets that you have discussed?
PEs have been with us, since we are a 13-year-old company, and for a good part of the journey, we have been a privately held company, mostly held by PEs. And we have given some very good exits to some of the PEs who invested in us. And currently, we have 3 large PEs invested in us, and they are very, bullish about the prospects for the company, and we have a good relationship with them.
What would you say is the USP of your business versus the rest? Because if you look at the growth rates, the asset quality, they do stand a bit different and better than the peers. What are you doing differently then?
As far as asset quality is concerned, it's a multi-layered process. Of course, the underwriting process and the initial onboarding process needs to be very strong. So we have over the years perfected that. And in this segment, even if the underwriting is good, because the customers come from a slightly vulnerable segment, they tend to go through ups and downs. So we have a very strong process of handling the customers through that process, providing exits for the customers. So many customers require help from us, to dispose of the property. So we provide that. We have a strong marketing team that is able to provide that support to the customers. And so it's like I mentioned, it's a multi-layered process. Both from an underwriting, credit, as well as a risk management perspective, as well as from a collection perspective, which helps us to maintain this asset quality.
Okay, good to have you on board. Thanks so much for joining in and sharing with us your growth targets as well as what the outlook is when it comes to financials. Just a quick check-in as to some of the stocks that are buzzing away in trade, some result reactions. Narayan Ridale as well is reacting quite positively. It's been a decent growth in the net profit at about 226 crores, up about 35% nearly. You've also got their EBITDA margin, which has expanded. So that's the stock holding out by a solid 5%. Wanted to also flag off Grasim. Do remember the profits have been lower this time around. The lower realizations in the caustic soda business as well as the decline in the global prices has impacted the standalone performance, but clearly the stock is holding out comfortably in the green. Kalyan Jewellers as well. It has been a pretty solid revenue growth this time around. Close to 27% is what they've clocked in, with their margins coming in at about 7.1%, which has been a bit of a contraction, perhaps why the stock is just quiet around the 337 mark. But let's get a move on then, and Rajiv Ratan is the chairman of the Ratan India Group, here to talk a little bit more about their earnings fine print. Thanks so much for taking time out. Now, given the fact that the company is diversifying from power and infra, lots of new forays into spaces like fintech and even manufacturing, what are your future plans for expansion? How are some of these businesses expected to perform?
See, right now we are fully focused on working on the existing businesses and growing them, and we are quite happy with the work that has been achieved so far. We are on a very strong growth path across our business lines, and as you would have seen this year, our first half revenue crossed 3,000 crores, 3090. In our e-commerce business, we have done pretty well. Our order frequency in e-commerce business is at 3.2 seconds for an order. So we are getting an order every 3.2 seconds. So we served 2.5 crore orders in last quarter. And we see 20-25% growth in that business. We are working on our private label lines. Those are doing very well for new brands. And coming to Revolt, that's a business we are superbly excited about. It is a business which is need of the hour, looking at the pollution around, and as we see our cities run into pollution issues, especially this time of the year. And it is imperative that we as a country start shifting to cleaner modes. And we are looking forward to great times ahead for all of our businesses.
Let's talk about that Revolt business a bit more. Can you talk to us about the latest tie-up that you have done with Adani Green? What could be the revenue potential? And overall for this business, what's the order book looking like in terms of the pipeline of the vehicles? What could be the overall size and scale of this business?
See, we are number one electric bike of the country for last 4 years, and we would like to maintain that position for next 5-10 years to come. And you can very well imagine any company which is number one electric bike of the country for next 5-10 years, what kind of value creation that will happen. So we are surely gunning after that. The bikes which have been bought by Adani Group shows their commitment to sustainability, not just in their businesses, but also in their daily usage. And that is also need of the hour for any company which is conscious about sustainability and responsibility towards environment. And this is just a start. So we are looking at replicating this across with the other corporates, and it is something which solves for two things for the company. One is, of course, that it contributes towards sustainability goals for that company, and also it takes away the entire process of reimbursements cycle that employee has to put in when claiming fuel charges for wherever jobs are such that the fuel is being reimbursed by the companies. So it is a very solid responsible value proposition for everyone, and it is just we are just scratching the surface on B2B side of Revolt business. Our B2C side is absolutely holding up and going great, and we are working on newer models to be launched in the coming year. We are working on R&D. We are looking at always improving the product as well as features. And it is something that we want to take global. We are looking at distributors outside India. We will be looking at Latin America, Africa, and of course, Southeast Asia, which are the key.
Coming right back to you, there's a new listing today, ASK Auto, and the listing process these days is about 3 days. I don't track the valuations here, so I don't know comment on it, but the screen is telling you that it's been a good listing for them, 10% higher, and it's been a good start. I mean, so many companies are going public these days that the IPO market is absolutely alive and kicking in terms of the theme. My basic question now is that if one really looks at Rajiv, the Ratan India Group, will it be known as an e-commerce company with a platform, or will it be an EV company? What would be the driver for the company or the group?
See, Ratan India Enterprises has 4 businesses today, and we are fully aware that as the businesses become sizable, so 2 big businesses should not be under this same umbrella. So, like as Revolt grows, so probably we will look at a demerger for our EV business from this business. So that'll become like a separate listed company.
And at what valuation would you be demerging them? I mean, what's the benchmark you want to reach? Because if I look at the EV space, most of the incumbents and the current big auto companies have already established a PE benchmark. Would you be doing the same for your EV business?
So it is something that we will look at maybe in 6 to 12 months from now. I really cannot say for sure whether we'll do it or not, but being a subsidiary of a listed company, so the listing route available through demerger is definitely available. And as of today, we are not dependent on capital from outside. But yes, as the business is scaling up and already we are getting interest from various quarters of investing directly in Revolt. And we will take a call in a few months from now. So for the past year, we took over the business fully in January of 23. And after that, we have worked on ensuring the building blocks for very high growth are in place. So there was the subsidy issue, which we've sorted. We were the first company to pay off the government on the subsidy issue. So we hope to be back on FAME 2 very, very soon. So once all that is set up, then we look forward to a phase of very high growth, and then maybe after some time we can take a call on whether to take an investment at the subsidiary level or to directly demerge it.
Okay, and we'll wait by to hear more from you, Rajiv, when as and when you decide on that demerger and whether you're listing it separately or not as far as your EV business is concerned. Thanks so much for making time and speaking with ET Now. But time now to slip into a very short break. But as we do that, listen in to the top bets coming in from Nilesh Shah, the MD and CEO at Envision Capital.
Really, digitization is essentially a very, very powerful phenomenon.
Yeah.
I mean, digitization, technology adoption. I think the Prime Minister himself has said that this decade is going to be India's decade.
Yeah.
We're going to see several businesses being built around technology. And so I clearly believe whether it is the consumer space, whether it's the financial space, the enterprise space, across the board, you're going to see many, many interesting business models evolve.
You like Zomato's business model?
I think it's a great business model. The biggest indicator is that today there is no third player. Nobody's even thinking about it. You look at any other space, everybody wants to get into this. This is one space when nobody wants to get in, or nobody's even talking about it, which means that there's something really, really strong, or what we call as moat, about this business, that what they have done for the last 10 years, nobody is confident of cracking the code. And that's what makes it so interesting.
It is India's decade to be, but the traditional techies have not done anything, barring a few KPIT or persisted. When will their time come?
I think their time is over.
Really?
I think the time
India
is
में
over.
किसी का time over नहीं होता है.
No, when I say over means
And you know,
as
coming
investors.
from him who has always tracked IT.
No, and I'll tell you why.
Sure.
It's not that these companies are over. It's just that for investors, they may not kind of give you the kind of returns that you're looking for because the growth is not very high. The growth is low single digit. Okay, and I don't think that's going to change.
Yeah.
Even if you look at the last decade, when so much has happened in the world of technology, these companies, the large companies, the top 3-4 companies, have probably barely grown at 10% in terms of revenues over a 10-year period. That too in rupee terms. In an environment where probably the rupee has depreciated by 2-3%. So the dollar growth has been 6-7%. So maybe in amongst the top 4-5 names, if there is anybody who gets the AI part of it really right, and if that AI part of it is very meaningful for their revenues, which means that it rakes in billions of dollars of revenues, then only will it make an impact. $100, $200, $300 million of AI revenue will not make an impact. That is the difference. Versus that the smaller companies, if they get AI right, it can change their world. It will be a game changer for
If you have to bet on 1 or 2 names, large cap, small cap, mid cap, SME, doesn't matter. What is a pure AI play? Because AI तो आ रहा है.
I don't think, Nikunj, we still have a pure AI play. We don't have, and at best, we would just still be a services play on AI, which means helping enterprises globally to adopt AI. So I haven't yet come across a pure AI play, but yes, a lot of companies are making noises. Some of them are making strides. Some of them have also announced investment plans in AI, but that's about it. But we still don't have a situation where a company is standing up and saying, okay, now 10% of my revenues is coming in from generative AI. That is something which we are yet to see. But yes, there are some companies which have made some very interesting noises in this space, and we need to watch out how these companies can take forward this, scale up, and make it a meaningful part of the business.
Other than banks, what will be the breakthrough sector this time?
I'm not too sure about the breakthrough part of it. I still think it's going to be the banks and the financials which have a strong part. Consumers might come back. When I say consumers, means consumer staples have been again under pressure for the last year or two. It's quite possible that if my hypothesis turns out to be true, which is we probably will see sobering inflation, that will leave consumers with more money. The consumer companies will have better margins because of lower input cost pressures. If all of that happens, then it's quite possible that consumer staples, which may not have done too well in the year gone by, probably the next one or 2 years, you might see them coming back.
You could look at me and we'll make it in 2 minutes. I'll put stocks which I know you won't. I don't know whether you still own them. Radico Khaitan, yes, no?
Oh, absolutely. I mean, continue to own it, have been owning it for a while, continue to own it, still like it. Margins are expanding. Their premium portfolio is still growing at about 20% in volume terms. It's still a long way to go.
Hitachi.
Still continue to own it. I still think the big opportunity is not yet played out. I mean, it's probably the best HVDC play.
Mahindra holidays.
Still continue to own it.
Okay. Tata Elxsi.
Don't own it.
Not anymore.
But have found better plays, not as better companies, but I think as better ideas. I think Tata Elxsi now has got priced to perfection. We need to honestly also as investors be cognizant of that.
You own United Spirits, Radico Khaitan and Sula.
That's right.
Then you own Bikaji.
No, don't own Bikaji.
You sold it.
Own Pratap. So probably a collection of all the names that you mentioned.
Three.
But I still think the three, especially Radico, Sula, in the financials, I think Home First Financial. That's a tech-driven, affordable mortgage lender. I think these are the kind of businesses which I think will continue to grow and
comes
remain.
on the first on Diwali.
Radico, Sula,
I mean, Nikunj, because I think by 3 years, I think maybe yet for the next 10, 20 years, the whole alcoholic beverages business will continue to grow. We probably are just at the start of this cycle.
You know, I must, since his top picks are Radico and Sula, so Delhi residents apparently have consumed liquor worth more than 100 crore rupees over the last fortnight.
Just 100 crores.
15
Just
days.
100 crores.
And they're struggling to breathe right now.